So the figures are out for the month of August, and it's very clear that there's still quite a strong price gap between detached houses and units. In fact, on a median basis across Australia's capital cities, there's about a $200,000 price gap. So as we've discussed previously, this is pretty good news for downsizers and empty nesters who typically do own detached houses. But to explore a little bit more what's happening with the market, I'm joined with Dr. Andrew Wilson from MyHousingMarket. And Andrew, welcome to downsizing.com.au.
Yeah, thanks very much, Mark. Yeah, there has been some, our latest data is out, so we can read the tea leaves and determine where we're headed in all this doom and gloom and uncertainty. But there's no doubt that the housing market still is very, very resilient.
Yeah. So look, what do you see as the current state of play, given that many of our readers, in fact, we think about 7 out of 10 of downsizers probably own houses.
Yeah.
What is the current state of play here with detached houses at the moment in Australia's housing market?
Well, it's been, perhaps the strongest market for owner-occupiers of detached houses that we've ever seen. And that's a big statement, but certainly it has been an across-the-board boom. Usually we see particular markets doing better than others on a capital city basis, but this time really it has been across the board. Number of reasons for that, and that's that we've really had interruptions to, I guess, the normal cycle, price cycle in our housing markets over the last 4 or 5 years, various reasons for that. And of course, we know COVID in our recent memories has been the most significant for that. So we've sort of got to the position where we've either had lower interest rates or we've moved out of restrictions from lockdown, and the market started to pick up and catch up from where it likely would have been without those interruptions. And then we've had another interruption, and that's what we have now. So it's a little bit like Groundhog Day. But the difference this time, of course, is that firstly, we're adapted to this in terms of our housing market processes. We are seeing higher levels of sales now than we saw through the first lockdown period last year. And of course, I think the other point is that we've got more confidence going forward as to what the outlook is. We know that this is hopefully anyway, the last of the lockdowns. We're now in control mode. I guess we're, in the policy position where we're going to live with COVID. And that means that once we get those vaccination rates to the level where our policymakers determine we can open up gradually, then our housing markets will be back, I guess, without the prospect of the interruptions that we've had over a number of years. But we're certainly still in catch-up mode, Mark, and that means basically that we haven't got back to the point where affordability is starting to look like a drag on house price growth. It is starting to occur now. No surprise, given how strong house prices have increased, or how strong the growth has been over the last year, that affordability is now becoming a drag on the market. But we've still got plenty of upside in terms of to the point where we get a flattening of house price growth. We're already seeing an easing of house price growth. You mentioned those recent numbers. But that trend had really been starting to emerge since June prior to lockdown. But the numbers are still very strong, and we're still averaging around about 1% per month growth nationally, and that's obviously annualised at double-figure growth, which is a very good news number for homeowners.
Yeah. But I mean, is there an actually, there does appear to be a bit of a supply problem in terms of houses coming on the market. It doesn't, is this an issue, and is this forcing up prices? There does seem to be great demand for detached homes in COVID, with people looking for space to live in, comfort, and yet at the same time, there doesn't appear to be a lot of stock. What's your reading of the situation?
Well, we need to look a little more deeply into the data. It tends to obviously produce a very rudimentary supply and demand insight, which really doesn't reflect what we're seeing. We're having record numbers of sales at the moment. We're going to sell more property this year than we've ever sold. So that doesn't sound like a lack of stock to me. The problem is we're just selling them too fast, and it's the churn and the turnover that I guess looks like that we don't have a lot of property for sale, because as soon as it comes onto the market, it's sold. So, but the point is, this is very much an owner-occupier market. So it is really about owner-occupiers trading amongst themselves. One becomes a seller, and then one becomes a buyer, and the buyer becomes a seller. And this really looks like we don't have a lot of choices, but the point is that it's the churn of the market that's looking like we don't have a lot of stock, when in fact the number of sales and the number of listings are quite high coming through, and that's only changed when we do get these lockdown interferences. But overall, this is a very strong market in terms of turnover. All we have to do is look at the auction markets prior to shutdown in July, and we had record months in March, April, May, June, July, and at the beginning of August for the number of properties put under the hammer every weekend, significantly record numbers. So
It'd be a bit of a black magic at the moment as to how you even secure a property. You need to be
yes.
sort of best mates with the real estate sister or something like that to get into it. So it does seem like you really got to work hard to secure that property. I wonder though, some of the increases we've seen for houses, say in Sydney, we've seen about a 26% increase in the last year. Canberra's been another very strong performer as well. Surely we must be running into a situation where the market just can't keep supporting these increases, and affordability becomes a factor. I wouldn't have thought this strong market will last forever. It must come back, surely. What's your view?
Well, absolutely. And that's what I said at the beginning. Affordability is starting to drag the market downwards. I run an affordability index, which looks at the proportion of the average income that's required to repay the average loan. And we are now above, on the national scale, we're now above average levels, 10-year average levels. And that always signals, when we put that against either the number of home loans or house prices, it always signals an easing in either home loan growth or house price growth. And it's no surprise that the standouts in terms of the local markets, which have pushed that affordability index downwards, are Melbourne and Sydney, which of course have had and Canberra, which of course have had the strongest prices growth. And this is the point. It's reasonably logical. You mentioned that perhaps you need an influence to purchase a house. Well, these days, because it's hard to secure them, but what you need is just more money. If you have more money, you can secure your property. It's an open competition environment. But the problem is that when you go to the bank and you ask for more money because you need to pay more for your property, the bank will say, well, okay, firstly, are you earning any more to be able to support a larger loan from your income? And you'll say, because we know income's growth is flat generally, the answer to that question will be no. And then you'll ask the bank manager for a cut in interest rates, because that's the other way you can afford to pay more. And the bank manager say, well, no, we're not cutting interest rates because they're about as low as they're ever going to be. So the point is that without higher incomes or lower interest rates, we can't keep pushing prices up. We still have a little bit of fat left in the system from the interruptions of the last few years, and that will continue to put prices, push upward pressure on prices. But we are starting to head towards the brick wall of affordability. And as long as and this is one of the key factors of Australians' housing market resilience, is the fact that we do have a very strict lending environment. And as long as banks maintain those strict lending conditions, you're not allowed to repay more than 25% of your income. And of course, those 80-20 LVRs, as long as they maintain that, it means that eventually prices growth will ease of its own accord because of affordability barriers. And I think that's a good thing. It's just that we haven't been able to reach that point because of all the interruptions we've had over recent years. And I think it's interesting, Mark, you mentioned Sydney had grown by 25% over the past year. And of course, that's a spectacular number, unbelievable number. But we have to go back to the late 80s to see anything to match that. But when we look at how prices have increased in Sydney over the last 4 years, it's actually averaged at 4%. So since 2017, even with this 25%, Sydney's house prices, median house price, has averaged just a little over 4% per year. So it is about getting back to a normalised environment. That's what we're heading for now, because we have had those dips in activity frequently over the past 4 years, well, twice over the past 4 years. So we're just in catch-up mode. So that's all good news. But what it means is that there are still opportunities for higher prices in the Sydney market and in most markets. But we are going to eventually hit that brick wall of affordability. But of course, what's happened now is that we've once again got the interruption of lockdown, which means we'll just extend the time frame till we do get to that brick wall.
Yeah. So just, I mean, getting out your crystal ball and always a dangerous thing. I still recall receiving media releases, Andrew, at the start of COVID last year, telling me that the house market was going to crash by 30% and we're all going to hell in a handbasket and so on and so forth. And of course, none of that turned out to be true. I didn't get that release from you, I may add, which
no.
But looking forward 12 months, just focusing on the house market, because it is a different market, as you indicated. It tends to be a more owner-occupier market. What do you think will it look like? Will prices fall from where we are today? Will they stay about the same? Will there be moderate growth? Or is it impossible to tell? What do you think, basically, on a capital city basis?
I think that the prospects now that we won't have any of those significant interruptions that we have had in recent years, particularly COVID lockdowns, and our fingers are crossed for that, of course, that we do have a different strategy now. It is the vaccination strategy rather than the elimination strategy. That once we do get to the point where we can open things up again, then that will normalise the physical capacity to transact property, to inspect, all the things that we can't do as we used to do at the moment. We'll then unleash a little bit of that pent-up demand that's been building through shutdown. I think that we'll have, again, another, not quite as strong as we had last year as lockdowns eased, but certainly a period of moderate to solid prices growth. I still think that overall, we've probably got 5 to 10% left in the market through this cycle. I do think, however, that'll work its way through into the autumn selling season next year and then start to peter out. The only prospect for lower house prices would be higher interest rates. That's what we know historically and logically, that if we make property more expensive, or to buy property to buy more expensive by higher interest rates, it takes a lot of buyers out of the equation. Now, we know there's no prospect at all of higher interest rates. That's another cheap headline that we tend to get quite frequently, as well as house price crashes. But we don't have a prospect for that. And the Reserve Bank, don't take my word for it, the Reserve Bank's told us at least 2024, and that was prior to COVID. So that means that our market will just run out of steam, basically, and then head forward, I think, with modest growth levels, perhaps 3, 4, 5% per annum. But that would be reflective of local factors, driving prices, the level of supply. Issues such as interstate migration will be important for prices growth. But we don't really have, once we hit that affordability wall, the capacity to continue to push prices up at those double figure rates, because basically we just can't afford it in terms of the bank's perspective to keep paying those figures. So I think that this will elongate the inevitable easing of the cycle, lockdowns. I think it'll push it into the autumn selling season next year. I think we've got up to 10% prices growth left, particularly in Melbourne and Sydney. But from then on, I think that we'll just, it'll be a much more stable environment in terms of housing market activity, and it will reflect on factors such as local supply and other factors such as changes in migration impacting local demand. And look, by saying that, it sort of points to markets such as Southeast Queensland, which are experiencing very strong migration at the moment as a result of those COVID issues primarily. And there's certainly upside to those markets, but we're talking on an individual basis here. So it is, I think, a better prospect for certainty and predictability in our housing markets. We've just got to get through this wretched COVID issue.
So, Andrew, what does the current market actually mean for downsizers?
This is, a very strong downsizers market, because obviously our market's been driven by record numbers of owner occupiers, and those that have been, I guess, sitting and waiting for the opportunity to maximise their trade in, and that's what it is. The family property that you've had for some time. This is certainly the best opportunity, because there is plenty of demand. Prices will certainly continue to increase, albeit lower levels. The other point is that we're seeing fewer investors in the market, although that is increasing now, but the proportion of investor activity is certainly still below average, and fewer first home buyers. So in a sense, for the smaller, in terms of demand for smaller properties, there's less competition. But the conundrum always for the downsizer, when it's, I guess, rivers of gold in terms of their trade-in, is finding a suitable property to downsize into, particularly in established suburbs. And we are starting to see a little bit of a light at the end of the tunnel now. Developers, particularly in Sydney and Melbourne, are looking at larger sized apartments that are a bit more appropriate for downsizers. And I think that we'll start to see those properties coming into the marketplace soon. And I think that sort of is the other end of the pineapple. It's great to have the very strong demand for your property and the record price, but it's most important for a downsizer to be able to find an appropriate next step in their journey.
Even if house prices are a little bit more subdued, I think we would all welcome a return to normality. So that would be good. And in fact, it may even help people get into the market. So Andrew, thank you very much for taking us through your analysis. You've pricked a few myths there, which is good. One about undersupply and also about market crashes. And you've given our readers a little bit of an insight into what could be happening in the future, which could help them in making their decisions about whether to downsize as well. So thank you very much, Andrew, and your time is most appreciated.
I appreciate the opportunity, Mark. Thank you.